Merry Dettmas. So unfortunately, January, the bills are coming in and people have that Christmas hangover, and what might have seemed like a good idea doesn't seem necessarily like a good idea right now, right?
Maybe it was a highway to hell.
There you go.
I'll throw it a little like music, a little music.
It's a bit of a groaner.
Little groaner, I guess, like ta-dun-dun.
Yeah, that's right.
But
So-
I mean, people, it's not just the holidays, I don't think, that really, maybe puts people in a bad financial position. Sometimes that might be the straw that breaks the camel's back.
Yeah, that's right.
In some, sense, I guess.
That's right. So how often do you see people in front of you, clients, and their debt is a problem? How often does that happen?
I think that, sometimes we see people who are kind of like robbing Peter to pay Paul. I guess that's kind of another saying I'll throw out there, that they're kind of borrowing to pay the debt. And that's not a place you ever want to be. I think credit cards sometimes get misused. Really, the goal with a credit card is you should be using it and paying it off. No one really should be paying interest on a credit card because, credit card interest is very high. Yeah. And in a lot of cases, the interest on a credit card is like 20%. I think in terms of maybe a slightly longer borrowing vehicle, like a line of credit can make a lot of sense. I think sometimes that interest rate is usually at least half of what it would be at a credit card. Sometimes it's lower depending on like what type of unsecured line of credit you might have. But again, it's not a forever plan. I know people who have money on lines of credit and credit cards who have had money on there for years, and basically they just tread water. Yeah. They're making the minimum payments. They have great credit, but they're not able to pay down the principal on these accounts. And oftentimes it has to do with the interest carrying cost. And a lot of times the payments that they're making, sometimes they're just interest. Or maybe they'll make the payment, that's inclusive of the interest, and then they draw the available principal back off. Oftentimes when you are, maxed out on your revolving debt, it brings your credit score down.
Yeah.
You could still make all your payments and never ever miss a payment, but if you're maxed out, that will drive your score down.
And it should, because it's a strong indicator of a problem, right?
And you're in a risky position, right?
That's
so
right.
if one little thing goes wrong, and then you can't make that minimum payment, obviously, then you may be in a default position. So, really through Merry Dettmas, there's really two issues that we talk about, Todd. Mm-hmm. For some people, they want to get in debt. They want to buy their first home. They want to buy a new home. So that's good debt. Right? So Merry Dettmas to you if you're buying a new home, and, we're helping a lot of those borrowers obviously arrange mortgage financing every single day. But then there's Merry Dettmas that might not be so merry, but maybe we can turn maybe a situation that's not so great into a good situation by leveraging the equity in the existing home. So when we talk about refinance, it's for existing homeowners that have some equity in their property. You can refinance up to 80% of the market value. And from that equity, you have to pay out your existing mortgage or secured line of credit or combination or whatever you have. Yeah. So you need to pay out the existing debt with the new credit facility. But then at that point, you can also use that equity to pay down that unsecured debt that might be a bit of a problem. The one thing that's really great about these house prices that have increased, a lot of people have a lot more equity in their property, Todd.
Yeah.
Right? And it's enabling people to leverage that equity in their home to potentially put them in a better position. Now, people are doing refinance, obviously, to clean up some of this unsecured debt, Todd. Oftentimes when we do these types of transactions, we have a conversation with the borrower and we look at their remaining amortization. And we look and see kind of what they're paying on that unsecured debt. And oftentimes, we can reduce the amount of years that the mortgage is amortized over. So imagine if you're paying, $1,000 a month on a mortgage and $1,000 a month on unsecured debt. Imagine even if you make your mortgage payment $1,500 a month, how much quicker it will pay everything off. Yeah. And mortgage debt is really the best debt. It's typically at the lowest interest rate of, any credit facility that you can get. Yeah. So, it's a great way to, use your home. Maybe not so much as an ATM, but as an asset to make sure your debt is in the best vehicle to really help you kind of, obtain a more healthy financial household, we'll call it.
How often do you see people do that? They go through the process, they clean everything up, and then they pile on debt again in 3 years and they're back to
it
try
happens.
and do it again.
It happens. Yeah. You know what I mean? Like, I think that there are kind of serial refinancers. But eventually, you'll get to a point where you just can't refinance anymore.
Yeah.
Right?
Yeah.
You will basically have leveraged everything that you can leverage. And if the home prices don't go up and you don't pay that debt down, that can be a problem. That's why a lot of these times when we do a refinance, we shorten the amortization. We help force the borrower to, pay down their debt faster. I think especially for people that have refinanced a couple times, I think sometimes we'll have the conversation to shut down some of these revolving accounts. Like, why do you need to have 3 credit cards? Why do you need to have 3 lines of credit, for example? Like, you probably don't.
Yeah, well,
you probably need one credit card, and you probably need maybe one line of credit.
If they've maxed one of those out, then if nothing's maxed out, you need one. That's it. Right?
Yeah, I think you definitely need one credit card for sure. And I would never, ever recommend somebody not having any.
Right.
I would never recommend that.
Yeah.
I think everybody needs at least one credit card. And I think, honestly, like a limit of $5,000 is sufficient for most people.
Yeah.
Unless you are self-employed and you're using that credit card and paying it off like every day, week, month, whatever, most people don't need a credit card of $5,000. And the one thing that I sometimes see, like I see people that have these credit cards and they're like $30,000 and they're maxed out. I think to myself, I'm like, why?
Yeah.
How did this even happen? And, I think we've all had, gone through challenges and, none of us are absolved of that. You know what I mean? Like, I've definitely had financial hardship in the past. I'm sure, Todd, you've had financial hardship in the past, but I think you need to like learn from those mistakes.
Right.
And you don't want to do it again.
Right.
And I think that, some of the coaching that we do with people, we can kind of set them up for success. And, we like doing an annual review with our clients. And sometimes it's just a little bit of tough love. And, even if there's clients that we look at a transaction and, it's not doable for whatever reason, we like to give them a plan. And then, I would say 9 times out of 10, people follow our direction. And then they are in a place that they can, get that transaction done that they want.
So it's a whole new application. It's a brand new mortgage then when you refi.
It's a brand new mortgage. And I think there's sometimes a misconception that you pay all the interest at the beginning of your mortgage. It's all based on the amortization, Todd. So it doesn't matter if it's a refinance or if it's a purchase. It's based on the numbers and what that amortization is. So you pay basically the interest that's based on the amount of mortgage that you owe.
Right.
So that's why I think sometimes when they do a refinance, looking at a shorter amortization oftentimes can make a lot of sense and leverage kind of that lower interest rate of that mortgage debt to pay off the debt faster.
And it's still much better than paying high credit card ratio debt.
Oh my goodness, yes. It's definitely always a better solution for sure. And, even like in a refinance situation, clients are looking at a rate of, in most cases, below 3%. I don't know any unsecured credit facility that is, at that type of rate.
Right.
And some of these debts that we pay off for people are at like staggering interest rates. So, I think it's about getting it cleaned up, making a plan, and then how can you forge forward with, a clean financial health going forward.
What do you want to talk about in the next segment?
I'm sure there's more refinance things we might want to talk about, but maybe we want to talk about,
credit.
Some credit. And I'd love to talk about first-time home buyers. Like, how can we get people into some good debt, and how is that Mary Detmus?
Okay, we'll be right back. Mortgage 101.